Today we are going to talk about taking money out of a cash value life insurance policy. So often we talk about designing a policy for maximum cash value. How do we use it with policy loans and such? But when it comes to distributions, meaning I'm in retirement or I want to take income from the policy, I'm no longer interested in funding it or borrowing and repaying. I want to distribute money in the most effective manner from my cash value life insurance policy. Well, how do I do that? So there are two ways in which we can actually pull money from a policy. Call it two transactional methods. We have policy withdrawals and then policy loans. A withdrawal is just like what you would think of with a bank account. If you've got $100,000 in a bank account, and we'll pretend that your bank account is earning 5%. Now, that'd be nice, right? If we just pull out $50,000, would we still earn 5% on the $50K we pulled out? No, it's gone. We pulled it out. We no longer receive interest on our money. So the exact same thing happens with a cash value life insurance policy. If we withdraw money, it's gone, no longer there. So there we go. Similar to pulling money from a bank account, money is gone, no longer earns interest. Now, it is not a policy loan, which we're going to touch on a little bit next, but with a policy loan, we have loan interest anytime we pull a loan. So with this, a withdrawal, we do not have loan interest. So granted, we don't earn interest anymore when we withdraw money, but there's no interest charge or expense either. Now, some things to be aware of here, because this is often overlooked, is if we take a policy withdrawal in the first 7 years of a policy, depending on how it was structured and how aggressively we funded the policy, taking a policy withdrawal can trigger a MEC. Now, it won't always, again, depends on our MEC limit and how closely we funded to that MEC limit, but when we take a policy withdrawal, that reduces the death benefit. It is considered a material change on the policy, and when that death benefit drops, that MEC limit drops as well. So if we do that in the first 7 years, we can run into an issue. As a quick example, if I have a $50,000 MEC limit, this is good information to be aware of because often we get the question from individuals, hey, can I just take a policy withdrawal out in the first 7 years or the second year? The answer is yes, but I've got to be aware of my MEC limit. Let's say I have a $50,000 MEC limit, and in policy year 1, I pay in $50,000. I funded up to the MEC limit. If I take a policy withdrawal in the first 7 years of a policy, I will trigger a MEC because I'm going to lower the death benefit, and remember that the death benefit has a direct relationship to my MEC limit. So that's where I can get into trouble on that. We can provide more detail if you have questions on that piece, but it's good to be aware of that. When it comes to taking policy withdrawals, I can withdraw up to my cost basis tax-free. Anything beyond my cost basis, if I pull it out in a policy withdrawal, I do have to deal with ordinary income tax on those withdrawals. So it's not capital gains tax with cash value life insurance, it is income tax. Very, very important to be aware of this. Often, if income is my goal, we'll look at withdrawing up to our cost basis and then beginning to loan out the rest. Especially when you look at a conservative dividend rate environment or the guarantees, that strategy we mentioned, withdraw up to the cost basis, then begin to loan out the rest, is often the most effective. Most corporations, when you look at executive benefit planning, will execute that strategy because it's the most effective from an income standpoint, especially when one studies the guarantees. Let's look at loans here. So again, main thing with policy withdrawals, this is a transaction. You can just withdraw money from a policy. If you do it in the first 7 years, you could trigger a MEC unless you have additional MEC space there, and we can always withdraw up to our cost basis. But if we withdraw beyond our cost basis, we have to deal with income tax, assuming we have a non-MEC policy. Policy loans. So why so many people are attracted to policy loans? Number one thing, our money always stays at work for us. Once you pay $1 into a life insurance policy, regardless if you just let it sit and grow, or if you pull money out, you continue to earn interest as if you never touched it in the first place. So here we go. Loans continue to earn dividends. Loan interest goes to, not yourself, to the insurance company. Now I can take a loan anytime, and there's no MEC risk. So it is true, if I take a policy loan out, what's going to happen? My death benefit's going to drop. If I go back, not back to the last example, if I look at an example where I have, let's create one actually. If I have a policy with cash value of $100,000 and a death benefit, let's put it over here, of $500,000. If you elect to take a policy loan, let's say of $50,000, right? The cash value is the gauge determining how much we can borrow from. What'll happen here? Policy loan, $50,000. Your available equity, what you can borrow from the policy, would be $50K. Now again, you're going to still earn interest on the full $100,000 because you took a policy loan, but our death benefit will drop to $450,000. Anytime we take out a policy loan, our death benefit is going to be collateralized dollar for dollar by the insurance company. So, with this said, our death benefit will drop, and there's no MEC risk here with a policy loan because loans do not trigger a modified endowment contract. Now, another thing, we're going to go into this in more detail in the next video. High loan balance can equate to a lapse risk. And if a policy lapses with a loan on it, we can be in for an unpleasant surprise down the road. Specifically talking about income taxation. This has happened a lot historically with IULs. You don't see it as much with whole life insurance, but it can happen. So that is a risk to be aware of. We're going to go into this in more detail in the next video. But overall, to recap, I can take a policy withdrawal from a policy, which is like withdrawing money from a bank account, does not accrue any loan interest because it's not a loan. However, I no longer earn interest on it anymore either. Taking withdrawals during the first 7 years does not always make sense because I want to make sure I don't trigger a MEC. However, when withdrawals make the most sense is often in retirement, when my goal is to distribute income from this policy. I pumped money in, I grew the cash value balance. Let's start to take income out. I can withdraw up to my cost basis without any income tax, and then begin to loan out the rest. As interest accrues, I do not have to pay it. We just want to make sure in all circumstances that that policy does not lapse. So, hope this helped and provided a little bit more information on the two transactions than usual. If you have any questions, reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.